It's really a great feeling at one level, but it's a little unnerving at the same time because of the way it just seems like our God-given right for the markets to go higher every single day. But when you look at the fundamentals behind it, and we're certainly overweighted at BMO with regard to equity side of the equation, but there's a lot of reasons to be there, right? So you've got great operating margins, probably the best in the world in the U.S. You've got margins that are not only great, you've got revenues doing better than expected, earnings doing better than expected, the valuations are reasonable, balance sheets are good. So there's reason to be optimistic. At the same time, investors have had sort of some risk drift in here, Maria. They haven't really been conscious, but their equity portfolio is up 30% for the year. Their bond portfolio might be down. So if they entered the year 60-40 equities and fixed, they might end the year closer to 70% in equities.
So you would put new money to work right here?
Well, we would put new money to work, but we'd want to revalidate that the investor is in fact prepared with some of that increased equity exposure that they've now gotten.
All right, Sandy, thank you. Bernie, what about you? How do you see this market on a day that, once again, we're at all-time highs?
Well, we're still positive on the market. We do think the U.S. has clearly been the beneficiary of QE, but across the world, we do favor emerging markets, principally because of valuation. And there'll be a lot of volatility when and if QE hits, but we think that just makes the case for putting new money to work there.
Emerging markets. So the valuations are certainly improved. What about the growth levels there? Do you worry that, in fact, the growth is not holding up to expectations?
Well, the growth rates have come down a bit, but they're still quite a bit higher than the developed world. And you have valuation levels that are 4 or 5 multiples cheaper than the U.S. Remember, the U.S. has been the cleanest dirty shirt in the laundry for a while. We think eventually that leadership changes.
David Sowerby, where are you on this?
Still look over the next 6 to 12 months. It's a market that you want to be participatory in. And it really centers on what matters most to the long-term investor as well as the near-term. That's valuation, that's cash flow, and I think it's profit margins. And all three are flashing a green light. Valuation, I think, is still quite positive. I'm finding great opportunities in names like Lowe's, Ford, Trinity on the energy infrastructure side that are selling less than 14 times earnings, whose cash flow is improving. Maria, if I roll all that up to the macro, I think it's still a positive environment for stocks with the acknowledgement that we're up 26%, including dividends this year. We're due for a hiccup, but you just grind your way through it because stocks will still be the best place to make incremental rates of return.
Yeah, and on top of that, Joe Bell, is the fact that there are very few alternatives if you want any kind of yield.
That's exactly right. You talk about bonds. Obviously, they've been a pretty big downtrend. Gold, not the best performing asset. U.S. equities have been in an incredibly strong trend, and sometimes it pays to keep it simple. The trend is your friend, as they say. Short term, perhaps we're in the midst of a little bit of a consolidation or a minor pullback, but I think bigger picture perspective, we're sort of in this transition phase where all those, whether you talk about pension funds, mutual funds, even the individual retail investor, they're starting to sort of accept this rally, but I think we're just in the beginning stages of that transition where that money is starting to flow off the sidelines, and I think bigger picture, I think there's higher prices ahead.